Let me start with a number that still makes me cringe. I was 25 years old, making $48,000 a year, and I signed a contract that locked me into paying $240 a month for life insurance. For 35 years, that is over $100,000 in premiums. And I did it because my friend from college had just started as a financial advisor, and he told me whole life was the responsible thing to do. He said it was like a forced savings account. He said I would thank him later. He was wrong, and I am here to tell you why. 7 years later, I regret that decision every single month when that automatic payment hits my bank account. By the end of this video, you will understand exactly why whole life insurance is a terrible product for most young people. The hidden fees and commissions that nobody explains, and what I should have bought instead. I will break down the real numbers from my own policy, the opportunity cost of those premiums, and the simple math that proves I would be tens of thousands of dollars richer today if I had just bought term and invested the difference. Whether you are 25 or 55, my mistake can save you from making the same one. Let me start with the sales pitch that hooked me. My friend told me that whole life insurance is permanent. It lasts my entire life. Part of my premium goes into a cash value account that grows over time. I can borrow against that cash value tax-free. And when I die, my beneficiaries get the death benefit tax-free. It sounded like a miracle. A savings account, an investment, and life insurance all in one. What I did not know was that the first 2 years of my premiums went entirely to commissions and fees. $0 went into my cash value. The agent earned about 60 to 80% of my first year's premium as commission. That is over $1,500 of my money in year one alone, paid to my friend. He never told me that. Now here is the pattern interrupt that nobody explained to me. The cash value growth in a whole life policy is abysmal. My policy guarantees a minimum growth rate of about 2%. The historical average is closer to 3 to 4%. Meanwhile, the S&P 500 has returned an average of 10% over the long term. The difference is massive. Let me do the math on my actual policy. I pay $240 per month. Over 35 years, that is $100,800 in premiums. According to my policy illustration, the cash value at age 60 will be about $85,000. That is a loss of $15,000 compared to my premiums. And that $85,000 is not even adjusted for inflation. In real purchasing power, it will be worth much less. Now let me compare what would have happened if I had bought a term life policy instead. At age 25, a healthy non-smoker could buy a $500,000 20-year term policy for about $25 per month. That is $215 less per month than what I paid for whole life. If I had invested that $215 every month into a low-cost S&P 500 index fund earning 7% per year, after 20 years, I would have over $110,000. After 35 years, I would have over $400,000. That is $400,000 in an investment account compared to $85,000 in cash value. The difference is over $300,000. That is not a small mistake. That is a life-changing amount of money. But wait, you might say, the whole life policy pays a death benefit of $500,000. The term policy also pays $500,000, but only if I die during the 20-year term. What if I die after 20 years? If I die at age 60, the term policy has expired. But here is the secret. By age 45, my investment account alone would be worth over $100,000. By age 55, over $250,000. By age 60, over $400,000. I would not need life insurance anymore because I would have accumulated enough wealth that my family would be fine. That is the goal, not a death benefit. Wealth. Let me break down the 3 hidden traps of whole life insurance. Trap number 1 is the surrender charges. If you try to cancel a whole life policy in the first 10 to 15 years, you get almost nothing back. The cash value is minimal. The insurance company keeps most of your premiums to cover their commissions and expenses. You are locked in. That is by design. They want to make it painful to leave. I looked into canceling my policy after 5 years. The cash surrender value was less than $1,000. I had paid over $14,000 in premiums. They would keep $13,000. That is not a savings account. That is a trap. Trap number 2 is the loan provision. Whole life policies allow you to borrow against your cash value. The interest rate is usually 5 to 8%. And here is the killer. If you die with an outstanding loan, the insurance company subtracts the loan balance from your death benefit. You are borrowing your own money and paying interest on it. That is not a benefit, that is a scam. Trap number 3 is the dividend myth. Many whole life policies are called participating policies, meaning they pay dividends. Those dividends are not guaranteed. They are a return of excess premiums, not a return on investment. In many years, the dividend is 0. And even when they pay dividends, the rate is often less than what you would earn in a high-yield savings account. So why do people still buy whole life? Because the sales pitch is powerful. Agents target young people who are afraid of responsibility and want to check the insurance box. They target high-income professionals who want tax advantages. But for 95% of people, term life plus investing is a better strategy. The only people who might benefit from whole life are the ultra-wealthy, who have maxed out all other tax-advantaged accounts and need a place to park millions of dollars. That is not me. That is not you. Let me give you a real example of what I should have done. If I had bought a 20-year term policy at $25 for $25 per month and invested the other $215 per month into a Roth IRA invested in an S&P 500 index fund, by age 45, my Roth would be worth over $110,000. That money is completely tax-free for retirement. I could use it for anything, and my life insurance would still be in force until age 45, which is when I would have young children and a mortgage. By age 45, my kids would be grown. My mortgage would be smaller. My investment account would be significant. I would no longer need life insurance. That is the right way to do it. Instead, I am stuck with a whole life policy that I hate. I have 2 choices. I can keep paying and accept the low returns, or I can cancel and take a massive loss. I have decided to cancel. I will take the small cash surrender value, buy a term policy, and invest the difference. I will take the loss as an expensive lesson. My hope is that you can learn from my mistake without paying for it. Now let me talk about the UK and Canada. In the UK, whole life insurance is also available, but it is less common. The same principles apply. Term life is cheaper. Invest the difference in an ISA or a SIP. In Canada, whole life policies also have high fees and low returns. Use a TFSA or RRSP for your investments. The math works the same everywhere. If you already have a whole life policy, what should you do? First, get an in-force illustration. That is a document from your insurance company showing your current cash value, death benefit, and future projections. Second, compare the guaranteed cash value growth to what you could earn in a low-cost index fund. Third, if you have owned the policy for less than 10 years, you will likely take a loss if you cancel. But sometimes the loss is worth it to stop the bleeding. Fourth, if you have owned the policy for more than 15 years, the surrender charges may be gone. You can cancel without penalty. Fifth, consider a 1035 exchange. This allows you to transfer the cash value into a tax-deferred annuity without paying taxes. That might be better than cashing out. Let me recap the key takeaways. Number 1, whole life insurance is a terrible product for most young people. The fees are high, the returns are low, and you are locked in for years. Number 2, the agent earns a huge commission, often 60 to 80% of your first year's premium. That money comes out of your pocket. Number 3, term life insurance is much cheaper. At age 25, a 20-year term policy costs about $20 to $30 per month for $500,000 of coverage. Number 4, invest the difference. Put the money you save into a low-cost index fund. Over time, you will build real wealth. Number 5, by the time your term policy expires, your investment account should be large enough that you no longer need life insurance. Number 6, the only people who might benefit from whole life are the ultra-wealthy, who have maxed out all other tax-advantaged accounts. Number 7, if you already own a whole life policy, get an in-force illustration and compare your options. Canceling may be the best choice. Number 8, my mistake cost me tens of thousands of dollars. Do not repeat it. Here is what I want you to do right now. If you are under 40 and considering life insurance, get a quote for a 20 or 30-year term policy. Compare it to a whole life quote. The difference will shock you. Then open a Roth IRA or a brokerage account. Set up an automatic transfer for the difference. You will thank yourself in 20 years. If this video helped you avoid the mistake I made, hit the like button. It helps more young people learn the truth about whole life. Subscribe and turn on notifications so you do not miss my next video, which is called The One Investment That Beats Any Life Insurance Policy. Every time.
And comment below.
Have you ever been sold a whole life policy? Do you regret it? Share your story. I read every comment. Thanks for watching. Now go cancel that whole life policy. See you in the next one.